One of the most striking observations in the U.S. is that even though the country is currently experiencing its worst riots since 1968, its worst economy since the Great Depression of the 30s, and its worst pandemic since the Spanish flu of 1918, the equity market keeps recovering strongly from its March lows. Joining me is Zach Abraham, Chief Investment Officer with Bulwark Capital Management in Seattle. Zach, welcome. So this makes no sense, and we talk about this a lot. What is going on?
So there's basically two schools of thought. That one, you will hear a lot of these times are always interesting in the investment world because you'll hear the majority, if not the vast majority, of investment people try to put a fundamental rationalization behind this because they have this religious-like belief in the quote-unquote wisdom or ability for the market to see in the future. And what they will tell you as well, the market isn't looking at today. The market's looking out 16 months from now. And I cannot tell you the amount of ridiculous rationalization I have heard over the course of my career with that logic, right? I saw an entire firm I was a part of use that same logic and to get their clients killed during the financial crisis in 08, 09. And I think that really what that is that's somebody admitting that they don't understand what's going on, right? They're going to tell themselves a story that makes themselves feel better. The other school of thought, which I think is probably pretty obvious that we align with, is that this unprecedented money print, what the Fed, and this has been going on pretty much for the last 12 years, right? Over the last 12 years, the Federal Reserve balance sheet has gone from $800 billion prior to the financial crisis to now where we're at $7 trillion. So that's money that the Federal Reserve has printed and just bought stuff up, right? And what the net effect of record government spending and record Federal Reserve involvement in the economy has been is that we've had the worst 10 years of growth in the history of our economy, and yet asset prices across the board are at record highs. So this isn't new, what we're seeing. It's just on it's on steroids, right? It's an exaggerated version of it. But the reason it's an exaggerated version is because the money printing and the government spending has gone through the roof, right? So what the government has effectively done, what the Federal Reserve has effectively done, is the market traditionally is a price discovery mechanism. What we mean by that is that if we put an asset in the market with as many players as there are, typically speaking, the market is going to be very good at determining what the proper price or value of that asset is. And the more people you have bidding on the asset, the more accurate view you're going to have traditionally. Now, what is happening now is that mechanism in the market has been completely broken.
Now, you're saying the natural pricing mechanism of the equity markets is fundamentally broken because the flow of capital into the markets isn't coming from investors, it's coming from the government, right?
What I mean by that is the reason markets do that is because people want to make money, right? So that's why they research. That's why they're trying to figure out what the correct price is. But when you have government printing and Federal Reserve printing and all of that stuff, the greatest flow of capital into the market is not coming from profitable companies. It's coming from the government. So what you've effectively done is you have made public equity markets and stock markets liquidity gauges. What they're telling you right now is they're telling you how much money the government is shoveling into the market. They're not telling you what the proper price of assets are. So we talk about this on our show too, which is, listen, what you are seeing now is you are seeing markets as liquidity gauges. The reason we dropped in February and March is because the market was afraid of, because of what was going on, that the liquidity was going to dry up. Now the market's rallied all the way back because the liquidity is on stronger than ever, right? So when you look at it through that framework, it makes sense. When you try to make a fundamental argument, I hear these guys doing these mental gymnastics trying to say, well, 16 months, listen, you cannot have the economic devastation that we have had. You cannot have unemployment rates at 15%, north of 15%, and think that you're going to get, quote unquote, back to normal in 16 months. It's not possible. So I laugh at those arguments, right? Now, we're not saying it's going to be a Mad Max world and it's a worst case scenario playing out. But, I think you've made a really good point, right? You've got record valuations and record levels across every asset class, including the stock market. And you could argue that there's never been a time in our country's history, maybe outside of the Civil War, where you had this much turmoil on this many levels at the same time. Yet asset prices are at a record high. What I will tell you is it's got nothing to do with fundamentals. It has nothing to do with what people think are going to be earnings in 2021. It has everything to do with government printing. And that's it.
That's Zach Abraham in Seattle. This is Retirement News Online. Thanks for watching.